Welcome back to the LPR Trading Group YouTube channel. It's Dave again. I just recorded this video, realized I had an audio issue. I'm circling back and I'm going to record it again for you guys. Today we're going to talk about exhaustion in order flow and how you can spot that in the market. Now this is a very important concept. I would never use this concept alone. We're going to use this concept and couple it with what we already know. If you guys are trading order flow, if you guys are trading off candlestick charts, whatever you're trading with, this is another tool that you can use just to add some additional confirmation to your trade or an additional piece of the puzzle. This is how I like to use order flow on the footprint charts that I use, which is the footprint charts that you're looking at right now that I run on Sierra Trader. Okay, so we're going to look at today primarily these bottom areas. Now what do all these mean? This top row is going to be delta, this second row is going to be delta change, max delta, min delta, total volume. The three that we're going to focus on today, it's going to be delta, max delta, min delta. If you guys don't know how to read these, I'm going to explain it for you guys really quickly. Let's take a look at this print right here. Okay, so if we look at this print and we visit the top row, we've got 1451, and that is in blue. How does that number come to fruition here? If we take all of these blue bars and we take the values associated with them, every single blue bar on this print, and we add them all together, we're going to get a number. Okay, we're going to get a total number of blue bars. That's going to be our positive delta. If we take all of these red bars, these are going to be our negative delta, which is negative or market sell pressure. Blue bars being aggressive market buy pressure. So we take all of those red bars, add them all together. Then we take the blue total minus the red total equals total delta. In this case, 1451. This is going to tell me we had a positive delta of 1451. There were 1,451 more aggressive contracts purchased on the offer than there were at the bid on this print. Okay? If we go down to max delta, we had a max delta on this print of 1461. This tells me at some point during this print, the highest the positive delta ever got was 1461. Okay? We go down to min delta here, or minimum delta, we have a negative 658. So at some point, this print, as it was unfolding and building itself out, it had a negative delta of 658. So this is telling me the minimum delta on the negative side was minus 658. Okay, so now how do we use all of this? Well, what I do when I'm looking for rotations is I like to first look for directional moves in the market, like this and like this. These are directional moves. Market going sideways is not a directional move. Once we have a directional move with some sort of authority, I like to start taking my eyes down to these bottom areas. Why? Well, if we look at the move to the downside, we have 1, 2, 3, 4, 5, 6 red prints. Okay? This first red print has a positive delta of 289. It's because, let me just scroll up a little bit here. It's because we have more aggressive buy pressure on this print by total than we do negative delta or negative sell pressure. So we just close as a positive 289. Print closes red and we start moving down. As we start moving down, we realize that all of the prints after that are showing a negative delta. Now, these four prints, 1, 2, 3, 4, negative 750, negative 520, negative 301, negative 470. All of a sudden, you get to print number 5, and you have this very bright color, which I've intentionally built on these charts or put on these charts, very bright color that stands out, and we've got negative 2097. What does this mean when we have a negative delta that's this large off of a move like this? In order to get a negative delta this large on a print that did not last very long, we would need some passive buyers sitting in this area buying up all of the aggressive selling. So if you're looking at the DOM, you're not going to see someone sitting here with 2,000 contracts or 3,000 contracts or 4,000 contracts. If there is a larger player, an algo, a firm, whatever you want to call it, committed to buying price at this area, they might start in on this area with 100 contracts. And as price comes down into this area, they can passive aggressively continue to load contracts into this area very discreetly. Okay, very, very discreetly. If they just sat 2, 3, 4,000 contracts on the DOM, we could all see it beforehand. We wouldn't know if it was real because they could always pull their order, but we would see it beforehand. And that is not good for them in disguising their positions. So once price gets into their area, they load it with a few contracts, and they just continue to reload the bid and hold price up as aggressive sellers try and sell into them and get nowhere. Now, with all that aggressive selling that's happening in this area, let's call this the area right here where there is 3,000 contracts that someone wants to fill passively on the bid. So it's a passive buy on the bid. You've got aggressive sellers selling into them, selling. They can't move price down because this person has a deep pocket, this computer, this out, whatever it is, there's a deep pocket here in the market. Aggressive selling can't get through them. Now, as soon as this price starts lifting up, what happens? All of these aggressive sellers that were sitting in here, price starts lifting, they're going to do what? They're going to cover. What is a cover? A cover equals a buy order. Okay? As price is moving up, if shorts are covering their position, they're essentially buying right here. And what are buyers doing when they see something like this? They're buying as well. That causes the market to move to the upside off of something we identified as an exhaustive market condition here. The move down until we got here was not exhaustive. It was very orderly and it moved down very fluidly. We got into an exhaustive market condition and the market started driving to the upside. For those of you who have watched our previous videos, I want you to notice something else. I'll give you a few seconds actually to pick it out, and it's something very critical in this print that adds a lot of additional confirmation to this trade. I'm going to show you guys what it is in 5, 4, 3, 2, 1. If you look at the low of this print, we have a 3 out of 3 perfect low. 3 out of 3 perfect low. We have a 0 to complete the auction. We have buy side imbalances at the bottom of the auction here, and we have failure to accept price lower on the sell side. It's a very nice 3 to 3 low. Price drives up, takes out this whole print. All of these sellers that are jammed up here, and now they're panicking and starting to cover their positions. Now, when we get a trade situation like this or an exhaustive move happen like this, you're going to have to figure out your way into the trade. We have a few things that we use in LPR, and one of the trades that you could have taken here was a simple scalp model trade. As soon as this print closes, we open the next print, buy the buyers, and let the price drive to the upside. I actually tried to buy this, and it missed my fill by 1 and 2 ticks. It is what it is. I did have a little starter down here at the low. I couldn't get any bigger on the trade. That's just how it goes sometimes. Now, for those of you that are trading just on candlestick charts or maybe a different concept, this is the exhaustive move right here. This is where the exhaustion happened, and we continue to drive to the upside to retest and take high of day at some point. For those of you that are familiar with TPOs and more into order flow and profiles, this is the TPO. Okay, so this is the TPO for the day. We can see D period, which is right here. This is the exhaustive move down here at the low. Where does it exhaust itself? Back into this larger volume area, back into this weekly volume point of control, almost to the tick, missed it by 1 tick. If I go back here to previous days and I mark this area out, why did I mark out this area? This is the congestion of volume for 3 days. Point of control, point of control, point of control by volume, 2 points of control by time, and all of the largest volume is being done in this area for these 3 days. This is where the market decides to pull back to and hold. I'm going to pull up another chart here in case you're very much into profiles and don't have much experience with TPOs or are not familiar with TPOs. You're going to see the same thing here. This profile on the right hand side, which is a week plus profile, if I highlight this, which are the highest volume areas, drag it over here, this wick is where the market visited or saw an exhaustive market condition that we reviewed on the footprint when we had that negative 2097 delta. If I go back here and I highlight these 3 days, 1, 2, 3 points of control within these 3 days, the largest volume on these 3 days is in this area, and this is exactly where the market pulls back to, right into this area, gets exhaustive, holds, and drives to the upside. One other interesting thing I want to show you guys is the market does one of 2 things. It's either balanced or it's imbalanced. Ideally, for me, I like to trade imbalanced market conditions. If this is market balance, this is imbalance, this is market balance, this is imbalance, this is market balance. There's a lot of people who are very good at trading balanced markets, just trading ranges, right? Identify a high, a low, sell, buy, sell, buy, sell, buy. I'm not very good at that. I trade imbalanced market conditions. Now, if we look at this chart right here, we can see this area is a balanced market range. Why? Most of the volume is done within this range. What does the market do right off the open? It drives up into where? Another balanced range. So if this is balanced down here, this is balanced up here, the space between the two is imbalance. So this drive to the upside is imbalance. And what the market likes to do is move from a balanced market into imbalance, into a balance, into imbalance, into a balance, etc., so on and so forth, over and over and over again. So if we look at that, this area being balanced, this area being balanced, we didn't know this happened yet because this balanced out at the end of the day. Market opens, goes from balance, imbalance, into the balance, back to where? The previous balance area, just to do what? Get imbalance again and go back to the previous balance area. Confusing, kind of, but not really, right? Balance, imbalance, into balance, back into imbalance, back into balance. This is how the market flows, especially on a profile standpoint. Okay, I want to leave that with you guys. I hope you guys understand exactly what I was talking about there. If you can use this in your trading, I highly suggest you guys to apply it. It doesn't happen every single day. It happens most days. Just have a look at it and try to identify it before you pull the trigger on it. See if you can line it up with any of your other systems. As always, if you guys enjoyed, like, comment, subscribe. I will get back to every single one of your comments down below. With that being said, good luck on the charts. Cheers.